Hello traders community. In this video, we are going to discuss about order blocks. Order blocks in trading refer to a situation where central banks or large financial institutions accumulate large quantities of a particular asset through one big order. There are supply or demand zones in which big players can find the comfort of placing large buy and sell orders and completing a very big transaction. Order blocks are specific candles or bars that, when properly viewed in institutional context, can highlight smart money buying and selling pressure. The higher time frame institutional order flow is critical to select high probability order blocks to trade on. There are two types of order blocks, the bullish order block and the bearish one. Let's start with the bullish order block. To put it in a simple way, the bullish order block is the last bearish candle before the impulsive bullish move to break previous swing high. Note that we must insist on the break of structure to validate the bullish order block. So let's see now examples from the chart. In this example, we are using 15-minute Nasdaq chart. We have a bullish order block. You can see clearly this last down candle before the impulsive bullish move that leads to this break of structure, right? We select this area and note it as a point of interest. We expect the price to return back to this level of price to take our long position. The target must be this swing high and the stop loss just below this order block. As I said before, the higher time frame institutional order flow is critical to select high probability order blocks to trade on. Let's move on now to another 4-hour bullish order block example. As you can see here, we have the last down candle before this up move that broke this swing high. We have a break of structure, right? So we select this area as our point of interest and take a long position once the price reaches this level. As I mentioned before, we expect the market to break this swing high and move upper. Let's move on now to the bearish order block. Bearish order block is the last bullish candle before the impulsive bearish move to break the previous swing low. It's nothing but the opposite of the bullish order block. Note that the break of structure is a must to validate the bearish order block. Let's move on now to the chart to see some examples of the bearish order block. We are using the 30-minute Nasdaq chart. We have a bearish order block. You can see clearly this last up candle before the impulsive bearish move that leads to this break of structure, right? We have our point of interest, so we expect the price to return back to this level of price to take our short position. The target must be this last swing low and the stop loss just above this order block. We have another 4-hour bearish order block here. This last up candle before this impulsive bearish move that broke the structure. We wait for the price to get back to our PY so that we could take a short position, targeting the previous swing low and setting the stop loss just above the order block. One of the most common questions is how to select the order blocks. A very important thing to note, you must select your order block on high time frame and refine it by returning to smallest time frames. Refining your point of interest will allow you to have more precision in your analysis and reduce your risk as well. As a scalper, you can't bear a very high level of risk or run in your position for a long time. Therefore, it's necessary to act on the small time frames, 15 minutes, 5 or 1 minute. Let's elaborate the refinement of order blocks by using the same previous example. If we switch the time frame from 4 hours to 10 minutes, you will identify the same bearish order block we mentioned on the 4-hour time frame. But in this time frame, you'll notice that the precision of this order block is higher and the risk is significantly lower. For each time used, you must switch to a smallest one until you find a more refined order block. We suppose that you are using the 15-minute Nasdaq chart. You spot this bullish order block and select it as your point of interest. If you take your long entry after this bullish candle and put your stop loss below the order block, your risk will be much higher than if you lowered the time frame to 1 minute, for example. Let's see what will happen in this case. Once your order block refined to 1 minute time frame, the precision will increase and your risk will be minimized. The target is not changing, it will be the same. Order block in market structure. When you are selecting the order block, you have to pay attention to the structure of the market. When the trend is bullish, you just have to select the bullish order blocks. The same for a bearish trend. You only select a bearish order block. If you trade against the market structure, you'll be out. Let's move on now to a chart example to clear things for you. We are using a 1-hour Nasdaq chart. You should not select the bearish order block as a point of interest because when you zoom out the chart, you will recognize that you are trading against a bullish trend. So here in this case, you just have to wait for the retracement to happen before taking a long position. For the target will be at the level of the previous swing high.